Welcome to another Maine SBDC webinar. My name is Kelsey Reardon, and I am with the state team hosted by the University of Southern Maine right in Portland. And today we have Maine SBDC at CEI Center Director and Business Advisor Raynor Large. And today we're going over projecting revenue. So this might be your first time encountering this, or you might be a part of our ongoing financial projections series. So in that case, welcome to part 4. For everyone else, don't worry about that. We're focusing today on future projections and revenue. So Raynor's going to be leading us through, I'm sure, several spreadsheets and many steps along the way. So if you have any questions, feel free to put them in the chat. Raynor also doesn't mind being interrupted. So if you want to unmute yourself and ask a question if it's timely, you should feel free to do that. Also, if you respond to any email you've ever gotten from me, it will end up in the same place. So if questions come up later, feel free to reach out. After today's session, I'll be sending out a follow-up email that will include the presentation as well as a link to the recording. And again, if you have any questions that come up later, you can just respond to that email and we'll find you an answer one way or the other. Like I said, stick any questions you have in the chat, but otherwise, I think we're ready to get started. We'll pass it over to Raynor.
Perfect. Thanks, Kelsey. And thanks, everybody, for joining me on a beautiful day. I'm going to be covering a lot of information today, trying to cram it all into the hour. So as I flip back and forth between slides and talk very quickly, if I mention something and kind of rush over it, feel free to draw my attention to it by taking yourself off of mute and interrupting me. We keep these meetings intentionally small so that we can have more of a roundtable discussion and try to answer your questions as we go through it, because some of this information is iterative and we'll build on it as we go. Kelsey's already covered this, so we're going to skip over that. So today we're talking about projections, right? And some projections are relatively easy. If you think about your overhead expenses, those are usually historic, and we can use benchmarks, contracts, or existing estimates to kind of project those forwards. Revenue is always a big question. How do you project revenue? Where do sales come from? If you think about starting a business plan, 80% of a business plan is about that top line, your sales, right? Your target customer, your pricing, what it costs to create it, what your competitors are charging, your marketing and advertising plan. All of that is really justifying your sales. So we're going to talk through exactly some of the logic behind that. I am not great at sales. I am not great at marketing. That is something that I don't do very well with. We have some wonderful advisors who do, but my approach is very analytical. When we're talking about projections, we're really talking about that income statement and a monthly projection of the revenue we can hope for and expect. So we'll talk about identifying a goal, identifying an audience for the projections, methods of projecting based on historic performance if you're an existing business, and then methods of projecting based on new business. That idea of inertia is something that we really focus on when we talk about projections. You know, the concept of the direction that we're moving, unless we act upon it with an outside force, is going to be the same direction we continue in. So always start with this, right? Strategies, not certainties. We're talking about projections. We can do a huge amount of work looking at industry data, greater economic trends, identifying our target customer. A lot of us did all of that work in 2019. And guess what? You know, COVID interrupted us in 2020. So nothing of what we're going to talk about today is for certain. It's a way that we can sleep at night. We can look ahead and have plus or minus, and kind of get an idea of where we're headed and how we can use the finite resources we have of time and money to try to impact that and have the greatest outcome for ourselves, our business, our customers, and our employees. So the first thing I like to start with is an audience, right? Who are we projecting for? And that's important, right? It sounds silly because projections should be projections, right? We should know, and it should be accurate. Well, accuracy is kind of in the eye of the beholder. And part of projections is setting an expectation. So if we're presenting these to a lender, if we're preparing these projections and taking them to a bank to secure a loan of some kind or a private investor, then we want to underpromise and overdeliver. Right? A lot of that conversation is about confidence. And when you're presenting these, you want to make sure that they're conservative and that you can meet them. The last thing you want to do when you're having that conversation is to come back in 3 months and say, I need a little bit more money. I didn't hit my projections. I'm not as optimistic anymore about where I was going. That undercuts your confidence, right? And undercuts their confidence in you to spend their money wisely. So if you're thinking about that from that lens, understanding that audience is critical. Now, if this is for yourself or it's for an employee and you're talking about generating sales or having some kind of commission, you don't want to underpromise, right? You don't want it to be conservative. It should be more aspirational. So again, yes, projections should be accurate, but is it something we're striving for? Is it a goal we're setting for ourselves? Or is it something that we have to make sure we're able to hit and meet? Who is the audience for it? So start with that. And then check yourself, right? Love this quote because I'm very pessimistic. I've come from a bankruptcy and turnaround background. So, pessimists sound smart. That's my whole job. I love advising. It makes me sound really smart. Optimists get rich, right? So understanding that audience, who this is for, if it's for yourself, don't be afraid to be optimistic. Set that goal high and go get it. But with changing inertia, starting from scratch and building or plotting a new path for yourself and your business, it's difficult, right? And optimism is why people start a business. You're optimistic inherently by nature. Pessimists don't want to start a business. It's too risky, right? I did that. I closed that chapter in my life. I'm not going to revisit it. So I always say, okay, take what you expect to do, and we'll circle back to this when we're talking about goal setting. Have the expectations, cut that in half, and double the expense, whether that's your time or your money. It's going to take twice as much effort and you're going to get half the outcome. And if it still looks good, great, let's go do it. And if it's not, how can we better spend that time or that money to grow your business? So there's kind of 4 ways to project. Honestly, there's 4 logic approaches, and we'll touch on the first 3. And then we're going to do a deep dive into the zero base, the idea of starting from scratch or doing something differently to change your business. As we're looking ahead to 2023, if you're taking this class, it's probably because you're not where you want to be, right? And so how do you change that? So the first 3 are relatively simple, and they're all kind of looking at what is or what was. That idea of recognizing the inertia and the path that you've traveled to get where you are. First is the easiest, contract, right? If you have a contract, that's very easy to project because it should say right in the contract exactly what the revenue is when. I'm not going to spend any more time on it because, if you have that contract, that's it. You did the work of projecting. It's done. Historic and relative are a little more complex. Historic is that idea of recognizing a trend. And I'll talk about pulling that information and how to project it forward. And relative is when you have a source of revenue that relates to another source of revenue, like warranties or service work for jobs that you've done in the past. Like that kind of recurring revenue is related to the jobs that you do, the hard work. So if you're projecting and looking out and trying to see where you're going, that relative revenue is going to be linked to whatever assumption and whatever work you put into the primary source of revenue. So you look at that as a percent of the primary driver. All of your marketing, all of your effort really goes into that primary driver, and you drive that revenue forward and drive it up. And the ancillary or secondary revenue stream kind of follows in suit. Right? So this is what it looks like from an Excel perspective. I love Excel. It's easy to plug in. You have it do the math. You have it do the work for you. So you can see kind of a couple different things I've done here. First is sales. Let's call it a historic average, and I'm not doing anything to change that. So all I'm doing is averaging the last 3 years. I'm saying, okay, it was 325, 315, 330. If I round the average, it's that equation that I've plugged in and it gives me my result. Easy, right? Service looks like it's historic, so same kind of concept, but it's trending upward. So instead of just using an average, I'm now saying, okay, what is the difference between the prior years? And if it continues in that trend, the difference in the prior year plus the prior year gets me where it will be next year. So again, very simple, just recognizing the trend, pulling the information historically, and then applying that going forward. Not doing anything differently than I have done. I'm not, I'm taking out external forces. I'm just saying it is what it is, and it is what it's going to be. Right? Contractual is very simple. It's simply the number that you have in the contract. So that's probably the easiest equation there is, right? It's just you read the contract till you find the line where it says the dollar amount you get paid for the work and you plug that in. And then that relative, right? That relative idea of, okay, historically, how has that been related and to what line item? I used warranty because that's easy. You can do the math for whatever you think you have as a relative revenue line and figure out, okay, if X dollar or if you make X amount in your primary revenue driver and 5% of that is in your secondary or 10%, what is that as a percent of revenue for each of those other years, the historic trend, right? And again, we're not doing anything differently. It's just recognizing what the relation is there and then projecting that forward. Now, when we talk about changing these things, and we'll dig into that a little bit more, maybe that's one of your focal points, is that relative, ancillary revenue stream. And you teach your sales force to really be promoting the warranty. Or maybe you give some kind of commission or bonus for somebody, for a sales agent who sells the most warranties as part of it. And you can watch that tick up as a percent of the primary revenue, right? So there's ways to act upon that and reward that to increase that. But again, just lay out some Excel functions there and you have your outcome. Now, part of this, looking at this is annual, right? And in Maine, a lot of our work is seasonal. What we want to do when we're laying this out, looking historically, is we look annually because we have these trends that are only really recognizable when we look year to year. And we can say, okay, this is where we've gone year to year for 3 years or for 5 years, or we've returned to pre-COVID levels, or our business models changed. And so it's really the last year that's the most important. So there's a lot of logic that goes into that, but understanding where you've been is so critical in understanding where you are and where you're going. So let's talk about seasonality, right? Because Maine has such a seasonal variance. And when we're talking about projections, I really like looking at a 12-month period. Month by month is nice because it takes into account some of that daily fluctuation and eliminates that, smooths that out. But Maine is so seasonal with the heavy winter and the tourists coming in the summer, that seasonality and recognizing how our cash flow comes in and goes out every single year is critical. So we can kind of do two things with that far right column, the result column, right? So we have our logic, we project our next year, and we say, okay, this is where we end up next year. We go from 593,000 to 632, and next year I'm expecting to be around 650,000. But is that good? Is that bad? How does January look? What's my February? Am I going to run out of cash in July and make it all back in September? So we can look at it seasonally, and we can look at it as a straight line perspective. Straight line's easy, right? Straight line is just you take that annual amount and you divide by 12. Boom, that's your monthly amount. Seasonal, now, depending on your industry, might be very seasonal or might be specific. Even some of your expense lines are going to be seasonal, right? Plowing, heating, and so on. And it's a little more complicated, but the concept behind seasonality and how we would project it is that you would look at your last year's seasonality, right? And you take that revenue line and you say, okay, January of last year divided by the total year is a percentage, right? It's the percent of total sales. It could be 0%, it could be 30%. It could be 8.5%, whatever it is. And we want to take that percentage and we apply it against our projection for next year. Basically saying, hey, if January of last year accounted for 5% of the annual sales, then January of this year should account for 5% of the annual sales, right? And you apply that logic month to month. So the annual amount remains the same of what you expect it to be, but the percentage changes to reflect the seasonality of prior year. Now, two things here, right? So one, seasonality might be impacted by COVID last year, depending on your industry, your business. So if you're looking at your business and you're saying, geez, last year's seasonality was really, put off by external factors, and I'm kind of past that, then maybe you want to use the seasonality from 2019, pre-COVID year, right? You go back to that. Or if you say, hey, it's a whole new business model, last year was accurate, I'm going to use that, great, we'll run with that. So again, kind of take a step back and look at your business as a whole and say, okay, where am I and where am I going? Is next year's seasonality similar to this year's, or similar to pre-COVID, or similar to some other year, right? This is what it looks like, just from a very simple, right, Excel format, is to just say, okay, if 2020, this was my seasonality, 5%, nice summer months, and then, it gets cold and it dries up again, and I did 276,000, all we do is we take our annual amount of 302,000 and we multiply it by that percentage, and now we have a new monthly amount projected forward that reflects the same seasonality, but the new annual amount. Any questions there? Okay. So that's it, right? Documented, historical, and relative. It's logical, it's straightforward. I can use Excel to play with it. I love it because of that. Right? If where we were going is still where we are going, chances are we're going to get there. It's just, it's inertia. So how do we start from scratch, right? How do we start a new revenue line, start a new business, add something to our business plan, or make changes? This is where it gets fun, right? So I always start from a global perspective. I like to start with the industry specifically. So start with your industry and go do some research, right? Most industries have specific benchmarks that you can use as a starting point. These are national. They usually don't change with the size of the business, but you can look at, turns per table for a restaurant, or, sales per booth. Most businesses or industries that are retail or restaurant or have a footprint have like sales per employee or sales per square foot. And the idea of the larger the location, the more sales you should be able to support or run through that location. So again, very global perspective, national database. You can use the IRS, you can use other things. If you don't have access to that information, reach out to an SBDC business advisor. We have some databases we can pull from. Rules of thumb. Are they going to necessarily apply to your business? Not necessarily, but it's somewhere to start. Then I would say, okay, let's take a step closer to where you are. Go to a competitor, right? Count the number of cars that go in and out of their driveway. Go in and sit at the table and watch customers kind of come and go, right? Who are their customers? What are they selling? What are the hot products that they're selling? You can support your competitors just by paying for their products and seeing how they interact and what the process is like and what they charge and how long it takes, and where is their competitive advantage? Is it speed? Is it customer service? Is it quality of product? Typically you can only compete on one or two of those things unless you have some kind of specific proprietary knowledge. You can't be the best, the fastest, and the cheapest, right? So understand where your competitors are and understand where the gaps are that you can fill, right? And that'll kind of tell you that idea of who is buying the product, why does it matter, and how are you going to compete with your competitors? What do people want that's not out there, right? If there's already somebody who's offering the cheapest product or the cheapest service, are you going to try to do it for cheaper? Does that really make sense to your model? Or does it make more sense to focus on quality or customer service and vice versa, right? If you're going to go head to head with a business and just compete on price, one of you is eventually going to run out of money. And if they're already in business, it's probably going to be you, right? It's very hard to enter a new market and compete with something that is already the competitive advantage of your competitor. So understand what they offer, why they offer it, and who's buying it so that you can adjust accordingly. So then we start talking about what is the difference between what you see in an existing competitor, what you see in an existing industry, and where you are starting at, right? And the difference is marketing, right? To get where they are, to get where the industry average is, you have to be active in your marketing. You can offer the best service, you can offer the cheapest product, whatever it is. But if nobody hears about you, then you will run out of business, right? Nobody knows what you offer, then you're never going to have a customer. So you have to market. Sorry, Corey, I know Corey's on the call. I don't like marketing. I'm bad at it, so I don't like it, right? We find people, we hire people who are better than us at the things we're bad at because they're still important to do, right? Don't diminish the value of it just because you're bad at it, if you're like me. But the value is the communication with the people who care and who need to hear about your service or product. That is how you get to the industry average. That is how you get to your competitor, right? So you start with active outreach and marketing. And that's really the focus of this conversation is how do you get to the revenue and the sales that you need, that you're expecting. And you have to be active. You have to be proactive in the marketing. So, I list a couple of things here, but it's that idea of you are spending time or you are spending money. It costs money to be active in your marketing. You have to go out and get in front of those customers. And what's critical about that is understanding what your customers look to or listen to or hear. If you don't understand your customer to know well enough what they're looking at, then you're never going to be able to reach them. If my target market is octogenarians and I am on Snapchat and TikTok, it doesn't matter how much money I spend, right? My target market is never going to hear about it. They are not using those things. So it doesn't matter where I'm comfortable. It matters where my customer is looking. So that active marketing is the outreach. Now, there's a whole nother aspect to marketing, which I consider kind of passive, like that idea of referrals and word of mouth and returning customers and, knowledge that you are in the industry. That idea that if a customer thinks, hey, I need this service or product, do they think of you, right? Eventually, your passive marketing efforts will supplant your active. You will be able to save more money, save more time, because all of the work you do in active marketing creates the passive market. But that takes time. It takes 3 years, 5 years, 10 years to build that customer database, to build that word of mouth and knowledge, geographic knowledge of what you do. To start, that business plan has to be focused on the active efforts of outreach, right? You can't start and say, word of mouth and customer referrals are going to generate all my customers. What customers? What word of mouth? Nobody's heard about you. Nobody knows you, right? Go get them. You have to. So to do that, one of the concepts that we talk about is this idea of pillars, right? If your business, your revenue model, it has, a break-even point or a necessary annual, monthly sales that you have to reach, you have to have several legs to that stool. What are you doing to support that revenue? So identify where your customers are and then go get them. How are you going to get them, right? So multiple pillars. Each one of these pillars follows a model of a funnel, right? The funnel is the idea that if I'm paying to reach 500 customers with an email blast and 10% of them click on my website, 50 of them click on my website, and 10% of that, 5 of them buy something from me. How many clients do I need to fill that funnel to meet my sales goal coming out the bottom, right? It's this, right? This is the funnel. And this is where it gets fun. It's like someone who's more analytical, right? As kind of that those ratios become so critical, because I can look at that and I can say, okay, how can I widen that funnel? Can I change the wording I'm using? Can I improve the quality of the people I'm dropping on the top, right? Does it matter if I'm emailing them on a Tuesday morning or a Friday afternoon? Does it matter if the value proposition is a buy one, get one, or a limited time offer, right? All of that marketing expertise, which eludes me, really boils down to that A/B testing of, what can I do to widen that funnel a little bit? Every customer I have to pay for to drop in the top, I need something to come out the bottom. Can I make that as wide as possible, right? So whatever your pillars are, outreach, email, phone calls, knocking on doors, flyers, television, whatever it is, they all have funnels. You have a customer audience that you're reaching and some sales that come out of it. And as long as you're measuring that and monitoring it and testing it, you can expand it, right? So every dollar goes a little bit further. And that's the exhausting part of a marketing plan, right? Is you look at it and you say, okay, I need 4 or 5 pillars to my revenue. Each one of these is a funnel. So for to hit my customer count that I need to make 320 phone calls and go to 12 chamber events and have 15 blog posts and send 26 emails. And it's like, oh my gosh, that sounds so exhausting. That's where the marketing plan comes in, right? A marketing plan lays that out in a calendar format and makes it a little less daunting, right? It's still exhausting. It's still time or money. But what does that look like over 12 months, right? How does that feed your business and support your business and change your revenue in a way that is sustainable for you? And if you're looking at that and you're saying, I can't do that, I don't want to do that, you can kind of do 2 things, right? One, you can widen the funnels so the number that you have to drop in the top is less, or you outsource it. You pay somebody else to do it for you. And that's perfectly acceptable, right? I'm the first person to raise my hand and say, this is not something I want to do. My first job out of college, a little aside here, was actually door-to-door sales with Verizon, commercial Verizon accounts in Philadelphia. It was 2009, right when the housing market crashed. I had rent I had to pay, and it was the first job I could get, and it was miserable. I was horrible at it. I did not like it at all. I lasted about 3 months before I found what I call a real job, right? Something that wasn't that. But it was long enough to realize how important sales is and how a good salesperson is worth their weight in gold, right? I was like, okay, I will absolutely pay someone to go do this for me as long as it's not me, right? So that's fine. Recognizing that, acknowledging that, totally acceptable as a business owner. Your time can be spent elsewhere. It still has to get done, right? If you want revenue, if you're looking at growing your revenue and growing your business, you still have to do these things, right? You still have to be active in your outreach and communicate your value to the people who care about it the most. One of the easy ways to kind of do this is with themes, right? It's one of the things I picked up from Corey is the idea of, if I have to make all these phone calls and do these events and the blog posts and the emails, they don't have to be unique concepts. That's overwhelming. If I break down my annual calendar into appropriate themes for my customers, maybe an email is a reflection of a blog post. Maybe a chamber event or a reflection on a chamber event leads to a blog post, and then I send an email about it. Okay, like I can double dip some of these things. Our customers are so overwhelmed by information and data that if we say the same thing to them 4 times, they're not going to be like, haha, you said that to me already. They won't even remember. Like, it's just, maybe they'll notice one of those things and be able to remember it, right? So don't worry about reusing information. being redundant, reaching them multiple ways. Save yourself some time and energy and track these things, right? If you have something that's very seasonally appropriate and applicable to your customer, revisit that next year, right? Maybe change the wording, change the date, send it back out. It's probably still applicable, right? And then, that idea of, okay, we're driving revenue. I'll skip ahead for just a while. I don't want to skip too far ahead. Driving revenue, we can use that to say, okay, how many customers do we need at a customer dollar amount? If we know our sales per customer and we know the number of customers that come out of these funnels, we can predict our revenue, right? That active marketing is that idea of we are reaching customers. Now, eventually, we'll get some of that passive income as well. But to start, it's only going to be what we can calculate with this, right? We can't count on word of mouth for the first 6 months of the business. We can't count on returning customers for the first couple months, depending on your industry, right? How often customers come back. And once we have those customers, then you can start working on that funnel, right? Customer retention, returning customers. That funnel can be widened by reaching back out, by checking in, by following up on a sales or a purchase, saying, asking about their service experience, or it's been 3 months since you bought this. Do you have any questions about how it's used, or how would you rate the service you received? That kind of follow, that widens the funnel. Right? It's reminding them that you're competing on customer service, that you're interested in them. And that brings customers back. So all of that work that seems kind of soft skills, right? That idea of just being friendly and chipper and smiling when a customer walks in, all of that kind of widens the funnel. We can reduce that to dollars and cents if you really want to. If you're super analytical and not an empath like me, hey, it makes sense from a dollar and cents perspective as well. So widening the funnel, we kind of just talked about this, sorry, but it's who buys your product and service and how are you reaching them? Do these funnels make sense? I've had clients who spend a huge amount of time on their blogs and they generate a huge amount of traffic to their websites, but the people that they're reaching out to and they're reading their blogs don't buy any product. It's not their target audience. It's not the people actually buying it. So it's a question of, well, who are they writing it for? Are they writing it for the appropriate audience to generate sales? If not, that's fine, right? There's a lot more to running a business than just sales. But in terms of projections, that's what we're projecting. So that's kind of what we're talking about today. Ask every customer, right? How did you hear about me? It's a great conversation starter. It's a great way to engage a customer when they walk in or, they're looking at their different products, but it tells you what funnels are working, right? Every customer that walks in says, oh, I saw you on Facebook, and you're spending a ton of time and money on Twitter and TikTok and whatever else. Maybe revisit that, right? If every customer is responding to one of these, then that's the one that's working. So ask your customer. You'll never know exactly until the customer gives you that feedback and says, this is how I heard about you. Oh, my friend told me. Great. My social media outreach is working, or my customers are referring other customers. That's a great indicator of value. And then this is kind of, it's a lot of text, sorry, but the idea of these funnels, you can also reduce it to $1 per sale, right? The idea of 320 phone calls, is a little more complicated, but if every one of those phone calls takes me 10 minutes and my value is $60 an hour, okay, great. That's a $10 phone call, right? And if I have to make 100 phone calls to get one customer, well, that's $1,000 to get that customer. Is it really worth my while to be on the phone all day? Well, if my average sales per customer is 500,000, yeah, I'm gonna be on the phone calling, right? But if my average sales per customer is $50 and it cost me $1,000 to get that customer, probably not, right? I might want to revisit that. So if you're looking at your pillars effectiveness, that idea of, okay, which is working for me? I have a finite number of dollars I can spend on my marketing plan, my advertising dollars. Am I getting the best bang for my buck, right? That's a huge question mark with a lot of businesses. oh, I budget $1,000 a month for advertising, but I don't know how to spend it. And I'm nervous about spending it anywhere. It doesn't seem like any customers are coming back. You have to be consistent and you have to measure it. And then you have to be comparative. And then you have to do the work of not only comparing it to other pillars, but comparing it within itself and tweaking that and saying, okay, can I get a little bit more out of this, right? Can I change the wording of that value add to get a few more clicks, to get a few more purchases, a few more visits to my website? Widen that pillar a little bit. As a business owner, you know, one of the things we constantly come across is that you just run out of time. Right? You know, looking at this, we've got input of time and you have an input of money. Money's kind of a joke, especially for a small business, because advertising and marketing, you know, who can spend money on advertising and marketing when you're, you know, working 80 hours a week, right? It doesn't seem to make sense. You have to spend money and you have to spend time. If you don't spend one, you have to spend the other. Ideally, you're spending some of both to have as many pillars as possible and you're measuring. This is a great way to kind of plan around that time aspect. It's the ICE method of impact planning. I use it for various projects, you know, within my own life, honestly. But it's a quick way of saying, okay, what is the impact that this effort will take? How much effort will it take? And what is my confidence in the outcome? And it's just a 1 to 5 scale. But if you're looking at 10 different pillars, you know, 10 different outreach opportunities, and you're saying what makes the most sense for me, you can rank those very quickly and just say, okay, what is the highest impact that I'm most confident in with the least amount of effort? Or you can use money if you want to use it that way, the least amount of money. And how do I maximize my work and my effort? We still have time. Great. We're doing great on time. Any questions so far? I know I'm cranking through this. Okay. So let's, I'm going to take a step back, right? So all of this, all of what we've talked about is external, right? The pillars, the funnels, the outreach, it's external. It's looking out and saying, how do I get that to me? How do I get their money in my pocket, right? An internal perspective on a new sales item, on you know, a new revenue stream, on a new business is a break-even point. And the break-even point, it gives you a post-it. And the post-it is the number of sales that you need a day or a week to succeed, right? So we can talk about sales, we can talk about everything all day, but this output of customers, how do we know what is good? How do we know what we need to survive, right? How do we know, if we know what we need to survive, then we know what we have to put in the top to make it work. So we went from the top down, now I'm going to start at the bottom and then we can go up. What's the floor, right? The floor is what we need to at least remain in business for another month. So a break-even point is essentially that. It's the operating floor of your business. It's the minimum number of sales that you need to cover your direct costs, your cost of goods, your ingredients, your materials, whatever it is, direct labor, and your overhead costs, insurance, rent, utilities, everything that exists, whether or not you sell anything. It's a relatively simple equation if you understand that distinction. So your cost of goods is all of your direct costs, which is exactly that. If you sell something, you have to replace your direct costs. Your direct costs, if you're a restaurant, are your direct labor, your chef, the person in the kitchen, and your ingredients. What is put on the plate that is being sold, right? Service is a little harder with cost of goods. You may have a service business without any cost of goods. If you're a construction business, it's your materials, your direct labor. Those are usually the two most important, materials and direct labor, right? One minus your cost of goods as a percent of revenue is basically saying, if I make $1, 30 cents of that goes out the door to my ingredients, and 25 cents of that goes out the door to my direct labor. So if I make $1, I get to keep 45 cents. That's the calculation, right? Essentially, it's the gross profit margin is just of every dollar I make, what is my value add that I get to keep? And that get to keep is important because that's what you have to cover your overhead. If I don't sell anything, I still have to pay rent. I still have to pay insurance. I still have to pay my bookkeeper or my accountant, my overhead labor, right? Those are fixed costs. Those are what they are. So the distinction there is important because fixed costs we look at as a dollar amount and cost of goods we look at as a percent of our revenue. Because if I don't sell anything, I don't have to spend anything on inventory. I don't have to spend anything on ingredients or direct labor, but I still have to cover my dollar amount of my overhead. So if I can calculate that, my gross profit margin, of every dollar I make, I get to keep 45 cents, and I know my overhead cost, then my total overhead divided by my gross profit margin is my break-even point. And it kind of looks like this, right? So my gross profit margin in this case is 44.45 cents. I get to keep 44.5 cents of every dollar. And my fixed costs in this scenario is 110,000, and 110 divided by the 44 is $247,000. So as long as I make and sell $247,492, I get to keep $0 to my bottom line. Like the math works out that 55.5 cents goes to my direct costs, that covers my ingredients, and I am left with my overhead. Okay. The benefit there is now I have a dollar amount of sales for the year. I can divide that by my sales per customer, and that gives me my target number of customers. And if I know my target number of customers for the year, and I know my seasonality, or I know that there are 12 months in the year, I can divide that appropriately. And I can find out my goal that, I have to have this number of customers for the year. In this situation, it's an ice cream and hot dog stand. I'm open 6 months a year. So if I know my annual break even for customers is 24,000, I really need 952 customers a week. Now that is an actionable goal, right? If I tell you that you have to sell $247,492 in product in the next year, that doesn't mean much. If I tell you you need 950 customers a week, okay, that's a little bit more actionable. Like that's something that I can wrap my head around as a business owner. I can put on a Post-it and put on my computer, put in the, the employee room and say, are we winning or are we losing? Is that the number of customers we have this week or not? Okay. If we want to fully load it, right? Fully loaded, take into account capital replacement, take into account, paying down debt, take into account equity draw, right? Those of you who want to actually pay yourselves and not just have a really time-intensive hobby, add that to your overhead, right? Overhead is a dollar amount, principal payment on loans are a dollar amount, equity draw is a dollar amount. All you're doing is saying, hey, if I'm keeping 45 cents of every dollar and I need that 45 cents to cover, my work, if I need that 45 cents to cover this principal and interest payment, just add it to it. Math still applies, and now we have a different number. It's going to be a larger number because we're accounting for more expenses, but that's the goal, to cover our balance sheet stuff, right? Like that equity draw, like that principal and interest payment on the debt that we have. Then again, that's the goal, right? What do you have as an owner that's actionable? What do you have that drives your performance? And does your marketing plan get there? So if now we have our customer output identified, that's our bare bones, that's our floor, that's what we have to cover all of our costs. We now know that weekly, monthly, annually, whatever it is. What are we putting into these funnels to drop that down? We know the ratios, we know we've done the work, we've done the math. Now we have to go get the customers, right? And then it's testing and it's improving and it's tweaking that funnel, making it as wide as possible, making sure those 320 phone calls result in the number of customers that we expect to drop to the bottom. And does it support what we need to run our business? If it does, great, keep doing it. If it doesn't, why not? What pillars do we need to add? How do we improve those ratios? And how do we generate more sales? So a couple tips and afterthoughts. We've covered a lot of ground, but be conservative. I always like to be pleasantly surprised. So, keep those funnels kind of nice and tight, and then go improve them, right? Keep that revenue driver low, and then be pleasantly surprised. A couple things you can do right off is kind of go out in the industry and check, what are your industry averages? Where should you be, right? That's a great way of checking where the opportunities for improvement are. If you run a restaurant and your turns per table are much lower than the industry average, great, we can work on that, right? If your price per plate is much closer to the ingredients cost and your gross profit's a lot smaller, great, we can work on that, right? It's in a way of identifying where the opportunities are for improvement. Looking at your whole business, it can be very hard to say, that's what I need to work on, right? Industry averages, really easy way to kind of say, oh man, I'm way off there. Why is that? What can I be doing better? Ask, how did you hear about me? Right? It's so easy. We do so much work into driving this, right? You do so much work to invest in your business and find customers and talk to customers. You're constantly, working the chamber floor or whatever it is. Follow up a little bit and you'll confirm that what you're doing is working, or you'll realize there's other opportunities, right? I had a client, I guess a couple months ago now, who has been paying for an ad in the Sun Journal for 20 years. The Sun Journal is very effective for a specific audience, but I asked him how many clients he's ever gotten from the Sun Journal, and he had no idea. He wasn't sure he'd gotten any ever. He just didn't know. 20 years, that's a long time to be paying for an ad, right? Just ask the question. It's worthwhile just to check with the customer. It makes the customer think you care about them and you're really just focused on this. But it's a great way to engage the customer, to talk to them and confirm that the dollars you're spending, those valuable dollars that you really wish you could keep and just take as a distribution, are doing something for your business, right? So check, and then measure, right? So much of this is hard work, and it's work that doesn't seem like it has any necessary reward to it. If you're measuring it and you're checking in, you can affirm your decisions, you can affirm your spending and your effort, and you know what you're doing works, and you can improve it, right? That's the goal for any of this. None of this is set in stone. None of this is going to get you where you want to go by itself, but the more work you do on it, and the more you measure it, the more you'll understand it and be able to improve those little things, right? Any questions? Other concerns? I've got one other anecdote I can share about this. Reward yourself is the anecdote I'm going to share. Excuse me. So this can be really hard, right? This idea of, I have all of this work I need to do to invest in my business, and I'm going to make 100 phone calls and maybe get one sale out of it, right? That's exhausting. That was one of the reasons I did not last in it, is because I didn't understand how to reward myself for the work that I was doing. So measure it, and that's part of it, but also understand how to incentivize these things. I worked with a realtor, a residential realtor, I don't know, a year ago, 2 years ago. It's been a while. But her whole business plan, her whole thing was one funnel, and it was phone calls. And that sounded miserable to me. And she didn't like it either. But what she did was, she had her separate bank account. She, ran everything through it, and she took her distribution pay, but she paid herself $5 per phone call that she made. It did not matter how many closes she had. Did not matter how many listings she had. Didn't matter how many showings she had. She understood that all of her business started with phone calls. And as long as she was making phone calls, everything else would happen. And so all she did was say, I'm going to, whatever I do that week, however many phone calls I make, I pay myself $5 per phone call for that week. And if I have 10 closings and I don't make any phone calls, I don't get paid that week. It doesn't matter the end result. What matters is that I'm feeding the funnel, right? And for her, that was a really easy way to kind of incentivize herself, because then when she got hung up on or she left a message, it was still a phone call. Those were the best phone calls because it was really quick and she still got to pay herself $5, right? So it became a pain for her to have a new listing because she would make the phone call and it would be a 45-minute phone call or a 2-hour phone call, and she'd only get paid $5. But for her, that was enough to switch the mentality of, this is disappointing, this is difficult, I'm getting hung up on, I'm leaving messages and nobody's calling me back. Those were the fun ones, right, that she got to pay herself anyway and move on. So sometimes it takes that little bit of extra effort and just understanding, what is incentive for you. You don't have to be a salesperson. You don't have to be, glad handing everybody at the chamber if that's not your style. Recognize who wants to hear about it and focus on that, right? That idea of getting hung up on getting told no, on a low response rate to an email, that's okay, right? It's also telling you who your audience is, and that can be helpful. You're not intruding if you're telling the people who care about it the most what they need to hear, and that can be important to remind yourself of as well. Anything else? Sorry.
Corey just said, what a great suggestion, which I agree with as someone who does not like making phone calls.
Yeah.
I wish I could pay myself $5 for every phone call I have to make just in general. Yeah, it's all about what's it? Something hacks. There's a phrase that's like brain hacks or something. It's like tricking yourself into doing the thing. And that's great.
Perfect. And there are wonderful people who can help with these things, marketing plans. We do a little bit. If you want to do a deep dive, we actually have someone on this call, Cord Zimmerman, who I can't recommend highly enough. So I'll just point that out. Thanks all for taking the time. We're here for our advising as well. So if you do want to do a deep dive, happy to help at least talk through some of the basics and set that up.
Awesome. Well, thank you, Raynor. Thank you everyone for joining. I'll send out that follow-up email later today and we'll hopefully see you at the next one.